Okay, we're now live. Welcome, ladies and gentlemen, to the Superlative Podcast. I'm Edward Bushi, one guest, no edits, no post production, just a sharp live conversation about what it really takes to reach higher levels and what comes next. And let's get into it. I'm really excited to welcome Shane Wilson of Cedar Capital. And Shane ran the numbers on two of the most valuable AI labs and concluded that a 50% reset would erase billions of dollars. We'd love to get into that. But before we do that, before we get into your story, could we have two sentences about Cedar Capital? And correct me if I'm pronouncing it wrong. And what you're building right now. And a big welcome to you, Shane, for joining the show.
Awesome. Edward, excited to be here. So Cedar Capital, we are early stage investors, meaning that we enter our startups around seed to Series A. We primarily focus what I call, we are nerdy generalists, in that we love deep tech, robotics. That's really the nerdy side. And on the general side, B2B AI. But early stage Bay Area investors is the shorthand for us.
Yeah, nice. So one of the key things I wanted to get into is you wrote two really amazing articles on your Substack about the AI bubble and really just giving more resolution to that. But before we get into it, right? You recently joined Cedar Capital last year, and would you like to talk about how you came into the investing game, and your role in Cedar Capital, because you, compared to your other colleagues that you work with, you're a words and musics guy, and the other folks are the nerdy technical folks. Would love to hear about that. Yeah.
Absolutely, and I'll just clarify, when I say nerdy, that's a positive.
I mean it in a good way too. Yeah.
So I linked up with Cedar Capital last September after business school. So I wrapped up business school in the East Coast, came out to the Bay Area, spent a couple of months out here, kind of getting my feet underneath me, and then I linked up with my colleagues at Cedar Capital. And it's a small fund. There's 3 total people, and actually the fact that I was kind of the first of my species was attractive to joining, because I really think that, we all have our biases as investors, as operators. We kind of see the world one way. And for me, my native language is go to market, commercial, sales, marketing, brand, that whole kind of thing. Words and music of kind of how business gets done is the right way to say it, as you did. To have the opportunity to, really be able to better understand how compute works, and what does it mean when there's a proper engineering breakthrough that's getting commercialized at a lab? What are the things that we have to look at? Those were all really complementary skills that just through collaboration was able to really pick those up. I'm nowhere near the lead guy when we start looking at a semiconductors company, but I know the first couple questions to ask. And as an early stage investor, it is impossible to be an expert on all things. You can either go super narrow and only look at things that you're an expert with, or you can start to adopt some heuristics and just kind of really, I think the goal for me over these last couple of months is, how do I merge that kind of nascent technical understanding with my more sophisticated commercial understanding? So this is how this business works. We need to make sure that we're at this level of maturity before we can commercialize. That's kind of what the whole exercise has been. But I mean, I'm never going to sit here and say, listen, I am now the world's preeminent expert on investing in compute. Nowhere near that, but I've got some of those skills. Now, to answer the initial question, what's the story? What's the path? So I was starting my career story as a college football player, Division I college football player. And I have not put a helmet on in over 10 years, but it's kind of my disclosure that I give to people is, one of the first things I mentioned, just because it's still the core operating system and how I approach work. But after college, landed in my first sales role in New York City. So I landed at General Assembly at a time when they were really having a cool moment. It was probably around Series B or so. I didn't even pay attention to funding that much back then, but a bunch of really smart people with a very positive view on how we could change the world, and just an incredible brand to sell behind. I think like I just like really adopted how important it is to have a great brand. Like that was such a cool place to be, whether you're a student or an employee. And did very well there. Got an opportunity to go to Amazon, helped launch a product at Amazon, and then spent 5 years at a seed company. Really kind of going through the paces of how do we take something to nothing without that brand support, and kind of learning in absentia how significant it was. But 9 years launching products, probably launched 8 or 9 different products and services across those 3 companies. And then I went to business school. That was really where I said, look, I'm going to transition from startup operator to startup investor. And if we put those 2 pieces together, then we've covered about 10 years of history here.
Can I ask, because you went to General Assembly and Audible, right? Those are like in their early days, or they're startups, but a little bit in their growth stage. But like, what drew you? I mean, as a VC, like you're going back in the sense of you're trying to find these early companies. What draws you to this kind of like industry as a individual?
Yeah, so General Assembly was what we would call like a growth stage startup now. I mean, your seed, pre-seed, A, B, C has changed a lot over the last, this was 2015, so it's over 10 years now. So there's been some shift there, but this was a growth stage startup. They were well established, they were well funded. The big dog on the block in New York back in those days was WeWork, but we were in the same zip code, in the same conversation as those guys. So that was the growth stage for General Assembly. Audible was post-acquisition. So I was technically working for Amazon. So I would not say Audible was a startup. Audible was a subsidiary that, at the time was kind of like, I would say, being quite well absorbed into the mothership. It had its own, it was in Newark, New Jersey, not Seattle, but everybody who kind of got hired, I worked for Amazon in the Audible division is how most of my colleagues at least interfaced it back then. So wouldn't call that a startup. But why was it appealing? Why did I go into it? There was, and I think that this is still the case when you work, at the time with General Assembly, like digital skills, like digital marketing was a very new and hot thing in 2015. Like we made a lot of money, especially in our B2B business, about how do we go from traditional marketing to digital marketing. So like that's where we were back then. And I think that's an important piece of context. What I recognize kind of being on the forefront of technology is there was less above me, in terms of like your organizational like chart, and that like nobody really knew how to do these things for business. And so a young guy who spent a couple of weeks to learn these things in a General Assembly class or doing some research on his own could actually kind of become an expert on these topics quite quickly. And I think that was the first thing that I recognized there. And then, there's just like, if you kind of try to stay close to the edge, for me, like it was the edge without any tech background. When I started at General Assembly were things like code and digital marketing. While I was there, we were incubating this new course that like nobody even really knew how to describe it, called data science. Like, I remember the first couple of days, they'd be like, all right, it's like part math and part code, and the outcome is magic. That's basically how they were selling data science back in the day. And, I took the class. I wasn't like at algorithm building scale, but recognized like, okay, there is something transformational here. Like businesses don't yet know how to use it. The potential is practically limitless. This is a place where you could really kind of follow and build a career. And so I followed that, for those couple years. And the seed stage company that I was with, eventually we were really kind of doing professional services, helping enterprises prepare for data science or prepare for AI. Now, when GPT happened, we were making a lot of our money teaching people Python. So, it became pretty clear that like, hey, maybe it's a good time to go back to business school to kind of, once I asked GPT to write my first Python script, I said, let me finish that business school application. But anyway, it was like, it was following that cutting edge and making sure that, even if I wasn't the preeminent expert, how could I understand a little bit more than the other folks? And thus kind of innovation became one of my edges as a seller, as a marketer, and then now, as an investor. There's not much of an edge on it. Everybody out here in this game plays on that edge, but I say at least I had some practice for it. So it was just that kind of like the opportunity for growth, as well as like the intellectual challenge of continuously evolving and trying new things. And, at where those two things interacted, a lot of creativity makes business happen. So that's kind of where I think it hit me in the feels for the early parts of my career.
Gotcha. Like I really appreciate that answer. In a way, it makes me think like being at the frontier is like you're teaching yourself, because the knowledge is not hardened yet, right? And you're essentially, I mean, I don't know if I'm characterizing it right, but like it's like giving yourself a master's or a PhD if it's very frontier enough. Yeah. So
Well,
yeah.
having a master's degree is a little different. Master's degree is
Oh,
telling you what happened in the past, and a PhD is going really deep on one thing. But I think really what it is in almost every profession, let's call it, a quote unquote traditional profession, you get rewarded for mastery of like standard operating procedure. And becoming better and better is usually a function of doing that more or managing more people to do that versus kind of thinking creatively. And working at that edge of innovation, it's more just like the chessboard gets flipped over it used to be every 2 years. Now it feels like every 3 months. And that really requires a different type of like mental plasticity. And you have to just kind of be willing to rethink things, go back to first principles, to quote master's degree stuff, use some frameworks to figure out what's really messy. But that's how I would characterize it. Education does a great thing, and it's really great, and I love it, and I'm glad I had the opportunity to go back again. But do not go to a university to figure out the cutting edge stuff,
no.
at least from a business standpoint.
Okay. Yeah. Well, for our readers right now, that's some nuggets of wisdom there, and talking about wisdom, in our onboarding call that we had earlier this week, one of the things that stuck with me is you said this line, and I could be butchering it, but you were saying that, and this goes back to like things you learned while you're operating. Good leaders are a requisite, stop you from failing, right? But are not a requisite for, or does not mean that you will succeed, right? Do you mind expanding on that? Like, because I want to have the people listening to this really like learn from this as I have.
Yeah. So yeah, this is the current iteration of it. So good leadership is not sufficient for startup success, but bad leadership is sufficient for startup failure. Meaning that you can be an A+ leader. You maybe went to a military academy. You worked in government. You have leadership on lock. You think, great, I'm going to bring this to startup land and I will be successful. You have a piece of what it means to be successful as a startup, but being a good leader alone is not enough to get you there. Yeah. On the flip side, you've had breakthrough research, you can code yourself to the top of the leaderboard in any competition. Maybe you've even worked in an elite product organization like a Facebook or a Google or so on. But you're not good at telling a story. Guess what? Founders are telling stories to investors, to their customers, to their employees. And that's usually the one where things fall apart the most. Because if you are maybe in a distributed team and we say something in this meeting, and then we say something a little bit different in this meeting, and there's misalignment, that creates friction and you lose efficiency. So leadership is a very important factor in what makes a good startup. Factor is the critical word because it implies multiplicative relationships between these variables. And that if we are 100 on leadership and a 0 on product, the equation comes out to 0. Flip it, reverse it both ways. It's very rare that someone is a pure 0, but if they are, like, we can end diligence right there. It's not going to work out. So that's that's kind of a reflection of mine. Probably over now. I mean, what I said, 2015 is when I started. That's a an 11, 12 year thing that we've just been kind of refining and tweaking on. But leadership's really, really important. It's not the only thing, but it is really important.
Yeah, and like if you know that insight, right, and can frame it that way in those like elegant words, I think you can just build systems around it just to like find it and discover it. So, talking about discovering things and learning about things, right? I learned from our onboarding call that seeded capital is right now at a stage where they're onto a new narrative, or they're developing a new narrative that you want to share to as many people as possible, right? And then I see shades of that with the reports that you wrote on your Substack, and it's very, very fascinating because you draw a few events that happened in the past few weeks, or past several months, and I've always in my mind knew that people are perceiving the AI industry right now as being in a bubble. But you basically pointed out there were several events, and I can name two of them that that happened, but almost went unnoticed. I didn't even notice it until you called it out in your Substack. One of them was DeepSeek, the DeepSeek moment. DeepSeek came out, and all of a sudden it proved that tokens are compute is cheaper than we thought. The second part was OpenAI actively charging, or rather discounting their tokens, right? Those two moments are somewhat an indicator that we're a little bit overpriced. But that's from my words. I would love to hear your framing of it, and so that we can get into it and talk about it more.
Yeah. Well, I mean, just first to touch on the narrative initiatives with SIDA, and then to dovetail into this one specific thing. So we're a small shop with SIDA. We have deep experience in go-to-market. We have deep experience in engineering and technical. We have deep experience in investing as well. And coming in as kind of the new member of the team last fall, the conversations were incredibly rich. With a small group, we could get to a very interesting angle quite quickly by relying on our relative strengths. And I think for us, what the narrative effort is it is finding the way to kind of let that lead and help other people experience kind of how we think as part of our investment process, and hopefully to do two things. One, to bring more people on board with respect to fundraising. This is something that every emerging manager is working on right now. But two, when we can interact with the founder on some of this thesis level, some of these, hey, we're seeing the market go in this way. Those conversations are exciting because we're able to kind of really kind of fast forward past some of the the first 3 slides of the deck about TAM and SAM, and we're saying we're both seeing the same big picture. Let's talk about how we pick this thing apart. And those conversations get really exciting really quickly. So that's really what the narrative is. It's kind of about putting those things out there such that we can have a more rich conversation across private markets. Now, pricing AI, big hot topic. This was something that I've kind of kept in the back of my head throughout grad school, and not even throughout grad school. I should say I was given a better vocabulary to discuss this in grad school, and in particular, this was the behavioral view of the markets. So there's been much literature that markets are perfectly efficient. They're self-regulating. This is something I think you typically associate with the University of Chicago. And then there is a competing view that was advanced from a professor at Yale named Bob Schiller, that the markets are definitely behavioral, and how behavioral they are cuts against the grain that, they're these completely rational markets. And so I studied under some great professors that helped break down the behavioral economics and behavioral finance. And I think that there's a really strong case that you could say that there is a significant behavioral impact on AI pricing that is driving the price up and is translating to irrational overpricing at the moment. So that's kind of the framing here. Now, some of the things that you hit on, and I'll just kind of give them those contexts, and then take a beat here because we go pretty deep. So the preceding event that really inspired me to revisit this and kind of put pen to paper was just a little murmur that came out a few weeks ago that there may be an open price war on tokens between Anthropic and OpenAI. They're both trending towards IPO. Anthropic is demonstrating better capture within a more valuable customer segment. OpenAI has a huge base, but not as much in B2B. They kind of are consistently putting out similar products such that they're practically commoditized. One of the ideas, and I believe it was coming from the OpenAI camp, was we'll drop our token price, we'll cut out our competitor and own the whole market. That is a dangerous game. It is a literal race to the bottom, depending on how long, you kind of spiral each other. And this has been pretty well monitored in economics. So I saw that and said, look, could this be the event that, actually pops the bubble? As I pulled in the thread, I think that you could make a case that at the roughly $1 trillion valuations, post price war, you would be paying 2x to 4x of the fundamental value of what these are. So like if we're at $1 trillion today, they engage in the price war. You came in at $1 today, your dollar is going to be worth 25 cents to 50 cents at the end of this price war. Now, that's where the thing started. Since then, we had I think what could be even the bigger spark to light the powder keg. We had some leaked financials from OpenAI. Were really bad, like really bad. Losing double-digit billions of dollars a year. That's an issue. That's a big issue. And we have actually kind of seen the market start to react a little bit. The market is down. We had a tough week in the NASDAQ. So I think some investors are sobering up to it a little bit. I think that, I'm patting myself on the back for being about like 4 days ahead. I didn't make any good trades to capitalize on this thing. But that's kind of that's what inspired it. And I would say just the last thing here before I take a pause.
Yeah.
DeepSeek Day is huge evidence of this behavioral relationship between the price, the prices of these assets. Because when DeepSeek Day happened, all of a sudden this assumption that compute was precious, models were difficult to replicate, there's going to be a small number of winners in this space. DeepSeek destroyed a lot of those assumptions. And in doing so, in quick order, the market dramatically recorrected someone like NVIDIA, who we were kind of assuming like they're the one person's going to supply. They've got relations with OpenAI. They got relations with, they're going to win this. They're going to win this. Well, once the underlying value of intelligence was diminished, we saw something like a 17% drop in NVIDIA. Where the real behavioral though comes in is when we looked at all the other drops that happened on DeepSeek Day, things like energy companies dropping 20%. They were, either we were being way overzealous pricing the future of their things in, but what I really think is people were being lazy and they made a very light argument that they sold people on of how tightly tied energy was to AI. And they ran those prices up. And then all of a sudden they deflated even faster than the hardware compute. So that's kind of, those are the antecedents, but let's get into it.
Yeah. So you're talking about how, I really love the Venn or the squaring this where you're talking about energy as well, because a lot of the assumptions of high energy stocks or prices were because it anticipated lots of compute. Lots of compute equals lots of demand for power and data centers, right? Like you talked about tokens being overpriced because we know they're overpriced because DeepSeek shows you how cheap they can be for compute. One of the things I'm interested in is like if your articles were talking about the only way Anthropic and OpenAI can like really justify their high price is if it's really that good, that only like high tier customers can actually use them and use them a lot. How much do you want to like take that scenario and see if that's pick it apart?
Yeah. So I mean, I guess the axiom here is things are worth what people will pay for them. And so right now people are paying a higher price, something like 60x, for a premier frontier model than they are over an open source. And there's some evidence that even some of the open source companies are getting a little less open to kind of, recoup some of their costs and things. So it's a dynamic situation, but fundamentally, you can access a free or near free model from a DeepSeek, a Qwen, a Kimi, that establishes a floor for what the tokens are worth, which is almost zero. And if I've got almost zero here and you're 50 cents up there, you're 50 to 100x more what that is. Now, it's not an apples to apples comparison. The Frontier Labs put out an exceptional product, and it gets better every couple months. I mean, like what are we on? 5.5 at GPT. We're on like Opus and Anthropic and like
4.7,
something like that. Like 2 years ago, we're talking about like, oh, hallucinations are a problem. Now I'm like, this can only string together 15 commands at a time. Like we're getting spoiled by how good these models are, and we're offboarding more and more of our sophisticated thinking to them. In a cost optimized mixed model environment, we might want to put 10% of the orchestration to the most advanced models. The other 90%, simple things, generating text, writing emails. You don't need that exquisite model to do this. We could offboard that to some cheaper models. So does that mean that, of your aggregate token consumption across your organization, only 10% is going to Anthropic and OpenAI? That gets pretty tough to justify the CapEx that they're spending on the compute to train these things, on the researchers they're paying to develop these things, which totally upends the system. And I'm not fully well read on it, but I know Microsoft has made some changes to their Copilot product now that is relying on a little bit more of a mix of models and is opening up a little bit. That could be a huge player to influence kind of the next chapters of this. So stay tuned on that. But I think like, the axioms that you can take away here is like, things are worth what people are willing to pay for them. And there is a very low floor. And if you don't need exquisite, you can get by. Let's say, Opus is the newest Ferrari. A lot of people are just fine driving a 15-year-old Camry. I can look out my window here and tell you that much. So how long are we going to pay that premium? That's kind of the underlying question for me.
Yeah. And I just to give it a real life example, I used to use Opus just to help me manage so many of my emails, like 20 emails on a go. But if I have a context file, I can just have Haiku do it, a much more slower model, but it'll do it well enough and much faster, which is actually a bonus to me. So yeah, you're right. You would question if you would need the Frontier model all the time, but I'm just one user.
Well, you're just one user, and the reality is, if we look at kind of the penetration of AI into enterprise, it's slower than you would think. And like what we say, proper enterprise. Like you have an IT function that has some ironclad rules. Like you might have Copilot, right? Like you might be able to like use it to write some emails on the side of your Outlook. They are definitely, and they are meant to be more of a first follower to a second follower. So if we're figuring this out as consumers and prosumers now, I think that the next generation of procurement and IT managers are going to be thinking pretty critically about this, because if it's a difference between you're going to be spending $1 million a year, $1 million a month on tokens, that's a pretty good line item to focus on and really make your name as the token cost optimization manager. So you're probably a little bit ahead of the business budget people on that split between Opus and Haiku, Edward.
Yeah. So talking about enterprise, right? I've been reading this line on your articles, and I think this is an important part to like draw the picture of repricing feels like coming close. I'm just going to throw this question here. One of your converging forces is enterprise capping AI spend. We're talking about enterprise. Uber burned its 2026 budget in 4 months, then capped it at $1,500 per employee. Is it a blip or the start of the repricing?
It's a start. I mean, I think like so let's think about how the forces in enterprise play. One, a non-deterministic model that sends information back to the cloud off premise and sends something back to you in the form of an answer. And there's very little control over what that model sees and very little control over what that model is able to keep. That is a nightmare for IT people. So they're digging their heels in and are kind of fighting a losing fight against AI. On the other side of the organization, you have your CEO who is now getting pressure from board members saying, where's the AI boost? Like I'm on other boards and they're able to reduce headcount or maximize productivity. Why aren't you doing it? So over the last couple of years, you've had these kind of like competing forces where maybe the highest leadership, who doesn't really care exactly how it gets done, is saying more AI, and you've got IT who's probably fighting back. The model companies have not been challenged to really give the IT manager, kind of the proper tools to manage these things and spend, et cetera. And it's fundamentally different than it was in the last generation of software, right, Edward? Because like if you went and bought Salesforce, you got one, this is the price per seat per year. You can model against it. It was pretty easy, but these things are super variable. So you had this kind of like unstoppable force, immovable object that was happening. And then, Uber's probably one where the executive leadership, we're going to be AI forward, give people everything, we'll figure out what happens. And then with poor responsibility, people exploded it. And I mean, it's like, it's anything that like, if you started giving away unlimited free snacks in your office, what do you think is going to happen? People are going to start taking them home. They're not going to be really responsible for it. So yeah, it was a blip. I think that it was like, I thought it was frankly galling as an investor that like the first batch Uber was kind of bragging about their token maxing. Like that does not fly in the public markets. Uber is a publicly traded company. Their CFO probably read that and was apoplectic. So this is the start. They're like, good businesses have always been financially responsible. As an early startup, token maxing may work out for you because you don't hire that many people. And, there's a whole bunch of different things at play why this could work at a small company. But at a big company gets rewarded for growing top line and keeping more of it as you get to the bottom line. And if you're blowing millions of dollars a month on tokens, you are going to get dinged in the public market. So yeah, this is the start. This is not the end.
Yeah. Okay. So I want to make an attempt to like create a steelman argument here based on a chat with another investor. I didn't get his permission yet, so I'm not going to name him, but it's in the episode list. But another guest mentioned that he argued that there's so much price-insensitive capital chasing big names that getting into Anthropic near a trillion has limited downside, maybe 20%, because revenue grows in the multiple. What is someone like him getting wrong?
So hold on, unpack that last part. So there's price insensitive capital. I'm assuming this is private market capital?
Yes, like hedge funds getting into early rounds. And then when the IPO happens, there's also price insensitive institutions, maybe like pension funds, for example.
Okay. And then the other part, the back half of the argument, play that back for me again.
That getting into Anthropic near a trillion has limited downside, maybe 20%, because revenue grows. There's still lots of room for revenue growth. What's he getting wrong?
Short answer is liquidity, but let me just get these numbers here. So he's saying 20% downside, 20% downside potential with Anthropic, and that revenue growth will account for any downside change.
Yes.
Okay.
There you go. Yes.
Cool. So liquidity is the question. Are we talking about real dollars in your pocket, or are we talking about paper valuation? Paper valuation can go infinite, but there's going to come a day when you have to return real dollars to your limited partners. And the only way to do that at this scale of trillions of dollars is publics. Now, maybe people are selling things out of secondaries. Maybe people are playing that kind of quick game. That SPV secondary market is very shaky, very unregulated, and I don't think that it's going to be there forever. So, hey, if you want to go play the casino floor right now, you can play the casino. I wouldn't call it investing. You're like in a really dangerous spot right there. And, if things go wrong and you are holding my money, I'm probably not going to give you more of it. So there's a risk tolerance question there. There's other things to be said about exactly where you are entering these companies. If it's a Series A and you're going to ride it up to, 1 trillion and exit to that hedge fund, out of your private position early, yeah, you can make some money. You can make some money, but ultimately, the mechanism that we're kind of built on is there's, what that is, I should say, Edward, is like, that's like betting on another bigger idiot, that whole chain, right? Like, I bought it here. I found another idiot who's going to buy it for me at an even higher value. Works for a while. You can make some money as long as there's another idiot. But when we get up into $1 trillion valuations, like, I don't know how many idiots that big can buy this thing. We eventually are going to have to sell it in the public market. And that's when things will get adjusted. And I would directly attack this idea that revenue growth alone will solve that, because the valuation is a function of revenue growth and revenue multiple. And the assumptions that go into the multiple are things like, this is a precious commodity. Other people can't do this. A dollar made by Anthropic is 20 times more valuable than a dollar made by Procter and Gamble. That's where it falls apart for me. So I'd say, like, you're playing a game that doesn't feel permanent. The bigger idiot plan only works so long until things change, and you're underlooking one of the core pieces of the valuation equation when it comes to the revenue multiple. It's not just the number of dollars in the door, it's how much you get for each of those dollars.
Gotcha. So appreciate that, Shane. So I just want to understand another angle that you're also painting here. The angle talks about how you mentioned it earlier. It's about energy, right?
Mm-hmm.
A lot of these data centers, this is part of the AI bubble narrative, right? A lot of these data centers, it sounds like, started or were financed by debt, right? And those interest rates can't be managed for a very long time, especially with compute costs going down. They might not even get a good return back. Do you want to talk about that a little bit more? Because I'm trying to understand how it affects the bubble clearly.
Yeah. So increasing amounts of debt have been used to finance compute. So the early stages of data infrastructure, less debt than there is today. There's been a point where we basically sucked up, quote unquote, all the good, reliable debt, like public bonds. And now we are kind of in the private credit space, which is kind of a new Wild West here, where there's plenty of good investors in private credit, but there might also not be as many good investors in private credit as public markets. So we are heavily levered. Think about your mortgage, right? Your mortgage is every month you owe something. There's a principal, there's interest. You pay it back, you're all good. You don't pay it back, the bank takes it, right? Your mortgage is a function of the cash. You pay your mortgage with cash flows that come in. So if you have $1,000 a month mortgage and you at the end of the month have $1,100 for your housing costs left over, great, you're okay. You're $100 in the block. But let's say you make less money next month, or your expenses tick up, and you only have $900, you're in trouble. There's a similar function for someone who took debt to finance their data center. If all of a sudden the cost of compute has dropped so low that I'm not going to pay you as much as I did for the same amount of output that I did last month, eventually you're under. What could happen? Well, the first move is the bank takes back a data center, or the private credit takes back a data center, whoever has it.
Yeah.
But if this happens all at the same time, where there's multiple defaults, this is like a great, a global financial crisis, 2008, 2009. So that's what we're really watching. Like, does compute drop to a point that this debt cannot be serviced? And then because there is so much debt, when we start kind of pulling that thread and unraveling that sweater, how much of the economy is exposed? And this is where scary words like bailout get thrown away, where all of a sudden taxpayers have to start doing it. So that's kind of like the fundamental structural risk that's going on. Is just like I didn't get my research done before we got here, but it's like $1 trillion that's getting projected to go into in the debt service from like a private credit standpoint. That is a lot of money. Like we're not talking about, a couple data centers anymore. We're talking about like the equivalent of like sizable countries' GDP at risk if these investments no longer start to pencil. And I mean, that's just on the compute, right? Like think about the other parts here. Like there's a ton of assumptions under this about, how long does it take for the hardware to depreciate? Is it a 5 year or is it a 7 year? If you're working at a 5% margin, that's a big difference. If you're only going to be profitable for, like 2 years versus 0 years. So
reminds me of Bitcoin miners. They're only good for a few years. Yeah.
Yep. So it's precarious. And I mean, like, look, I'm definitely spending a lot of time, painting with the black brush on this story. Like I'm still an AI bull. I think that AI is going to happen. Nothing is going to stop this thing for us. But we do have to be level-headed about like where we are in this part of as investors. And it's another thing that I spend a lot of time thinking about is just like the nature of financial bubbles. And what happens in a financial bubble? Most people think financial bubble, the underlying asset was worthless, you should never invest. Well, like, no, actually there's some more sophisticated economists who really recognize that a bubble is a part of the financing cycle, part of the mega cycle.
And that's the title of this podcast.
We're getting to it, right? It only took us 41 minutes. Sorry, everybody. Fast forward to 42 minutes. So look, what happens? Now, a bubble doesn't mean that the underlying technology was worthless. A bubble describes how capital flows into the projects. And usually, this is I'm cribbing off of a very smart economist called Carlota Perez, that a lot of VCs have read, and I would recommend reading her books on financing innovation. And she tracked a couple of the big innovation cycles, railroads, fiber optics, these kind of like infrastructure heavy build outs. And what happens is the promise of the new technology is very enticing, and people can see it could do all of these amazing things. And they go out and they raise money and debt on that promise, and it becomes kind of a runaway trend, right? It just keeps inflating because people get more and more excited. They want to get in on the action. Let me get a piece of that. They're doing less diligence. Deals are happening faster.
And
capital is coming. It's happened before, and it's probably going to happen again. And so that bubble inflation is what's called the installation phase. What happens is some event comes and it pops the bubble, deflates the bubble, wherein capital leaves the system really quickly. And this is when a lot of that paper value gets erased. After which, the investors who thought they had all this paper value, they're wiped out. They lost their money. However, society wins because now this infrastructure is around and compute becomes very cheap. Railroads become very cheap. Fiber optic becomes very cheap. And it becomes kind of a new input for the next generation of innovation and entrepreneurs. So this is part of like holding two competing thoughts in your head. Like AI is the best thing that's ever happened to us. It's the best investment opportunity in the world, but we have to be careful about, what we're really buying. And, the answer typically is not stop investing when the bubble happens. The answer is look for truly good businesses that are, kind of riding this tailwind, and they would survive even if the market collapsed around them. They have their cash flows figured out. They have good management. And, guess what? That's just being an investor. Find the good companies. Don't invest off the hype and the narrative.
Yeah, I appreciate that. Even like talking about data centers, basically like houses, where where the data center companies are getting rent from these AI companies. But I like the analogy where if the token prices are low, they can't pay the rent of or the mortgage of the data centers that they just constructed. I love that analogy, and I loved how you talked about like the financing phase that we're in right now. So one quick thing, I haven't I don't know where to find this, but like the legal documents of these data centers. Let's say they do go bust, right? Um, what happens to the data centers inside of them? They can Anthropic just like say, hey, I want this, but I'll just move it, or is it claimed and erased? And then because I'm just going by your there will still be infrastructure there, but
There will still
what if the
be.
bank just destroys it?
So I think it would be unlikely that the bank destroys it, because the bank is
Okay.
not going to all of a sudden overnight. Well, I don't know. I mean, Allbirds is trying to do this right now, right? But anyway, the bank overnight is not just going to say like, okay, we own a data center, burn it down, and we're going to build a Walmart parking lot on top of it. Like,
Yeah,
you
I'm
know, the
exaggerating,
bank,
but yeah.
they're smart people, right? Like they underwrote this based off of the collateral and the assets. So, you know, the data center owner defaults. They're going, you know, there will be some agreement in place, usually with the debt, you know, some sort of covenant that says we're the, you know, if we're the, you know, last in, first out, or some of these different rules. But basically, somebody is going to say, if this thing is belly up, I own it. And then they are going to have the opportunity to sell it. They will probably sell it at a discount. They're gonna, you know, they're gonna try and recoup some of their money, because the banks aren't meant to be long-term asset holders in you know, this physical infrastructure. They're meant to have money in their coffers, and so they're going to want to liquidate that stuff. And the pressure to liquidate en masse, where many banks or many private credit, distributors all of a sudden have these things lying around, they're going to be much cheaper than they would have built. So value, you know, real value lost there.
Okay. Okay. So one of the things I assumed coming into this call, and I'm glad you proved me wrong, is like I assumed that Cedar Capital was waiting for time. Seemed that they were just going to time the market and wait for the repricing to happen and all the downstream events. But the way you're thinking about it is like you have it in your mind that this repricing will create many negative downstream effects, but you know it's temporary. So you're looking for people that are going to survive, right? That's what it sounds like. So do you want to talk about what you guys are doing at City Capital, and
Yeah.
would love to hear some companies that you backed.
Yep. So timing the market is a fool's errand. Many people have tried it. People have said I can do it, and they almost always are not. They're either fooling themselves or fooling people around them. So like fool's errand to try and time the market. The better fundamental thing is to just kind of look for good companies and buy. I think, what does Warren Buffett say? We buy $5, or we buy $10 bills for $5. Like, that's the only person who I'd say across almost a century has been able to beat the market is someone who is not actually looking at the market, who's kind of looking at the fundamental value beneath it. Now, that's a plug for value investors. They're much more sophisticated than I am. Anyway, what are we doing at Cita? What gets us excited? So we are an emerging manager. We're investing out of a $100 million fund. That puts us, in terms of today's VC, we are quite small fish. We don't have a $15 billion fund or an $8 billion fund where a lot of the capital is concentrating. We need to play a different game. We can't take a 10% stake in Jan LeCun's latest idea. Somebody else with deeper balance sheets is going to do that. And you know what? They probably have enough dry powder that if there is some type of crazy correction, they're going to be okay. Maybe they're looking at a position in SpaceX that they were recently able to exit. All's hunky-dory, right? It all comes out in the wash. We don't have that luxury. We need to look at smaller companies earlier in their journey and try and grab them before a breakout. Maybe that breakout is not quite as big as, an AGI for all, every man, woman, and child. But there are a lot of really good businesses here. And frankly, the ones that I think are more often to be overlooked are things that are doing steady growth that can probably survive a reprice. So one of our investments that I love, it's called Botrista. So we are robotics investors. And our favorite robot is, what I will say in the most loving way possible, is quite a boring robot, right? Okay. This is Botrista. You go, check out their website. What they have is, it's a device that lives in a QSR, quick service restaurant, lives in a QSR behind the counter, and you put a cup under it, and you press a button, and you get a boba tea. press a button, you press the screen and you get a milkshake. You say, well, Shane, that sounds like a cocoa-free style, or it sounds like there's a cappuccino machine in the bottom of my luxury building that makes me a cappuccino every day. Same idea, but what Botrista is able to do with actually quite sophisticated technology in the cabinet, multiple semiconductor chips, they're using AI to talk about how to blend ingredients, when to incorporate them in the mix. What's going on in the background is the type of work, or really kind of a product that increases revenue for a huge TAM of customers. Think about your QSR restaurant. To hire an employee at a QSR, you basically need them to be value adding in like 20 minutes.
Sorry for pausing. What does QSR mean again?
Quick service restaurant. So fast food,
Gotcha.
fast food, but maybe like a little bit more inclusive. But you've got the idea. There's a big board and it's advertising the new drink of the month. Well, guess what? If you buy $7 for the special new drink that costs them $1.50 to make, that's great margin, right? But if that $7 drink is reliant on, Edward needs to be on his shift because he's the only person who knows how to make it, and then Edward gets a job for $12 an hour versus $8 an hour or something, he's out the door and we don't have our highest margin product. So this is what this is doing, is at the scale of QSR, where we know there's millions and millions of restaurants worldwide. It's creating it's improving certainty and ensuring high margin capture. That is awesome investment. The company's doing incredibly well. Botrista, check these guys out. That's one that we really love. I found a company, I guess it was towards the end of last year, just got up with the founder yesterday. They're called Visto. I love Visto. They're awesome founders, Harry and Tom, based out here in the Bay Area. They
separate from Vistaprint, not that company.
Yeah. Simpress, Vistaprint. They make a pretty good coin off of printing your business cards. I think that's a Dutch company. But no, Visto, Visto.
Gotcha. Visto.
Really, really elegant business motion to get this product out the doors. So it's a GEO company, generative engine optimization. So if you think about SEO is what brings people to your website based off how they navigate search engines. This is helping companies, brands, and products populate in ChatGPT, Anthropic, etc. So clearly, our information searching part of the awareness funnel has shifted from Google to Gen AI, and they're helping companies show up better there. Now, they're not the only player in this game. There's a lot of companies out there, but what I really loved about what Tom and Harry were doing was they were thinking differently about the customer set, and that there are a ton of SEO agencies out there who have multiple customers. And rather than kind of trying to sell against the agency directly with customers, they created a collaborative pricing that was attractive to the agency to purchase this. And then for each new client that they brought on, that was even more valuable to Visto than the agency itself. So it was this kind of like win-win collaboration, and it led to some really great growth out the gates that really allowed them to establish themselves and kind of get to those first fundraising hurdles. So there's an example of a company that I really like. They're thinking about distribution smart. They're able to actually get themselves out there in a way just by being like a little bit more creative, right? They don't need to make a magically new product, but using good product with a better business motion, probably a better business than good product with an okay business motion. So there's two examples. What are we looking at? What else is exciting? So I'm super into space. I love it. I think when we think about how big a market can go, it's practically impossible to figure out how massive this could be. I'm a neg on data centers in space the same way I'm a neg on data centers on Earth. But there are really cool opportunities when we think about how do we see things better in space? How do we maneuver things better in space? How do we construct things in space? Those are some really cool big picture things that are tough to kind of wrap our head around. Were we talking about quantum earlier this week, Edward?
We in our onboarding call, right? We did. Talk
what do you
about
think?
quantum.
You're a quantum.
Well, I chatted with a quantum investor, right? And by the way,
Okay.
I looked back in the the podcast I had with him, and the quantum technology that he was talking about, and maybe would love to get your thoughts on this. He was talking about that there's this quantum technology. It's very messy right now. It's like a four-tier model of quantum computers, not the Tesla, but this quantum technology is called neutral atom, right? And the nice thing about neutral atom is that it executes the main core functions of compute quantum scale, but does it without making it super cold. And the unlock of that is that it lowers compute. Lowers compute costs because it's not energy intensive anymore. Uh, so yeah, like would love. You know what? Maybe I'll introduce you two like after this call, and maybe we can like make another discussion out of that. But yeah, I haven't dug in too deep, and yeah, like there's many ways we could cheaper compute could unlock things. But yeah, um, yeah, that did you want to go somewhere with the?
No, I had a vague recollection. You had some thoughts on quantum. Would definitely
Yeah.
be interested in the investor and neutral atom. I mean, this is one of those spaces where the surface area of opportunity seems so big, and like when there's that dynamic where we can like see like the entire world could be shifted for it. Now it's easier to take these kind of like crazy pie in the sky bets because like the risk is still super high and we could still win there. I think like dovetailing it back into data centers, like risk is high, but like how much bigger can it go is very different than risk is high, but infinite frontier. And like quantum's one of those things. It's like I love listening to people talk about it as long as I can follow. You know, my brain's going to get bent.
Yeah.
Back to being a generalist investor, we need to like pull the heuristics out. But things like dramatically reducing the energy cost for compute. Okay, we can play ball.
I'll be sure to share with you the episode, and it's on my YouTube just for folks listening as well, on the Superlative Podcast YouTube. So yeah, I want to say, Shane, like this has been like a very well-rounded discussion. I really love like bouncing ideas with you and taking arguments and destroying them and having you pick them apart. I really love that format together. So I know that your article, right, is a part of a 3-part series. Do you want to talk about the third part coming out, or is it too early? Just to hint it.
Yeah, I'm looking at a draft on my other screen here right now, so it's coming soon. So 3-part series, started with what happens with the token price war, TLDR. We could be anywhere from 2x to 4x overvalued at the intended IPO price for Anthropic and OpenAI. Piece 2, if the companies that, for all intents and purposes, are AI take that big of a haircut, how could this trickle through both the private and public markets, and what's kind of the hole that we could be looking at in the economy? TLDR, pretty big, not quite like a global financial crisis, but maybe like a Black Monday, especially if it happened really fast. Last question is just what happens if that debt question on data centers comes to the fore, and that costs have gone down dramatically on the tokens, or what we're willing to pay for compute drops off a cliff. Could that be significant enough to cause like a proper systemic issue, things where we're talking about bailouts, etc.? So still nascent. I can tease the series. I can say read parts 1 and 2, part 3 hopefully early next week. I kind of, it's one of these things where like I have a hunch of where this thing's going to go, and I've already kind of teased the argument here. What I actually have to do now is the proper, I have to do it. I got to talk to my LLMs a lot to do some of this research to figure out exactly, like how do we think about the unit economics of a data center, the dollars in versus dollar out. So it's coming. I will say I feel validated. I started writing this series 2 weeks ago, and now the market's down a little bit. Like I said at the top of the call, I should have made some more bets. Should have been more confident in my analysis.
Well, there you go. And look, I love that you wrote it, and it was a pleasure to read on Wednesday as I was developing this podcast episode. So forgot one thing. If folks
Yeah.
want to reach out to you, I know you have a Substack. I know Sita has a website. Do you recommend other ways that people can reach out to you or folks in your team?
I'm a ghost other than LinkedIn. I do it because you kind of have to be out there. So Substacks where I put my thoughts. I usually promote them through LinkedIn.
Yeah.
Those are the right places. Shoot me a note. If you're a startup founder and you want to talk to us about investment, send me a deck first. That's, I'll say hi back, but send me a deck. I want to see that before we jump on a call.
Yeah.
But yeah, LinkedIn's probably the right place to grab me.
Okay, perfect, wonderful. All right, at that, Shane, thank you for coming on board to this podcast, and would love to have a version 2 of this in the future where we see if anything's changed or how the market's changed too. Would love to go over that.
Happy to do it, Edward. I'm sure we'll meet in 6 months and we can have a here's all the things you were wrong about call.
Yeah, we can have another argument.
Yeah.